Okay, good morning, ladies and gents. My name's Matt Harry. I am in sales and distribution for Apollo Crypto, and I'm here this morning to bring you what we would call an entry-level crypto education session. It's become apparent to us in our conversations that we're having with those in the investment and advisory space, should we say, that many still haven't either taken the time to understand the very basics of Bitcoin and how it works, or that some of you have done that previously, but over time have not kept an eye on the space and have kind of forgotten. So you'll notice that today's webinar will be fairly basic stuff. Some of you may be a little bit more advanced, and that's fine. You may or may not find value in the content. But for those of you that are just sort of starting out on your crypto journey, you should find this a great base for your understanding of the broader crypto space. You will notice that the content or the deck is quite content heavy. I've done that on purpose so that I can send you this deck afterwards and you have kind of, I guess, a reference document. It can be quite tricky trying to remember the complexities of this particular market. So we're providing you with something that you can refer back to. So with all of that said, I think we might just jump straight in here. So I won't bore you with all of those details of the full team and read those in your own time, but I guess the two main people to be aware of are Henrik, who is Chief Investment Officer, and he's also the co-founder of Apollo Crypto. Founded in 2017, first fund, the Apollo Crypto Fund, launched in early 2018. So it's a pretty unique skill set that Henrik has. He spent 20 years in global financial markets, including 10 years on Wall Street as a tech analyst. He's very well connected in the space globally and also locally. So that gives him, as the kind of driving force behind the portfolios, direct access to some of the best and I guess the sort of future category leaders in the space. Henrik's been very, very good at assessing and accessing those over the journey, which we'll come back to. The other gentleman that you need to be aware of here is Mark Woodward. He spent 20 years as a technology venture capitalist. He's a career funds guy, so obviously has a significant bearing on the direction of investments in the portfolios. Then we've got a couple of very clever analysts working with us, Matt Harcourt, Wan Ning, and also Quinn Papworth, really smart analysts that really live and breathe the space. And we're also potentially in the next few days announcing a new arrival, quite a high-profile analyst from the space that we are excited about coming on board. And then less importantly, myself and Brad Sewell as the sales and distribution guys. So starting from the but no one really actually knows who he is, which is an interesting little fact in itself. It was created as a response to the GFC, as a way that individuals could regain control of their financial sovereignty. This is especially important for millennials, which we'll come back to. The millennial demographic, they've grown up in the shadow of the GFC, and research has shown that they have a fairly significant mistrust of financial institutions, given the way that we've seen financial mismanagement throughout their life. But they have also grown up with technology, and they trust technology almost implicitly. And it's very important in how they direct or allocate their investment capital, which we'll circle back to again. So Bitcoin in a fast, cheap, and highly secure manner. So the Bitcoin blockchain, or the Bitcoin computing network, is the most powerful and secure computing network on the planet, which many are not aware of. Because Bitcoin has zero weight, it cannot be counterfeited. It's highly divisible, non-sovereign, and secure. We actually see it as a better financial asset than gold. It has proven to be an excellent store of value over its now 15-year history. If you zoom out and think longer term, it's basically been, yes, granted, it's been very volatile. The price of Bitcoin has been very volatile, in line with the sort of 4-year halving cycle, which we'll come back to also. But over time, it's been an excellent, in fact, it's been the best store of value globally over that period, best performing asset class. So we believe it's an excellent store of value asset. In January of this year, we saw a kind of a watershed moment for Bitcoin with the advent or the approval of SEC-approved spot Bitcoin ETFs. So this is now allowing institutional investors to allocate to the crypto asset class with regulatory certainty. The ETFs have been the most successful ETFs ever launched. In fact, by really clear blue sky, if we look at the, I think it's approximately 285 new ETFs that were approved last year in the United States, the combined total capital inflow to those vehicles for calendar year 23 was surpassed by the Bitcoin ETFs in the first 11 days of them trading. So really, really significant and impressive demand for this asset and this asset class. If you compare it to the first gold ETFs, which went live, I believe, in Australia in 2003. So those gold ETFs took 5 years to reach 50 billion in assets under management. The Bitcoin ETFs, 57. So the ETF market's never seen this, and we believe this kind of daily passive demand that's coming through from these vehicles will really underpin growth and help in kind of tailing off a little bit on the volatility over coming years. So really exciting time for Bitcoin and also Ethereum, which we'll come back to because it has also had an ETF launch more recently. So the Bitcoin as digital gold concept, we often talk as Bitcoin as digital gold, as a safe haven or inflation asset. When we speak of centrally issued or government-backed money, the reason why all forms of centrally issued currency or money have failed over the years is that the controlling entity can simply increase supply and inflate away the value of that particular currency. In fact, centrally controlled forms of money have historically lasted from between 80 and the US dollar is very much in the back end of that bracket at the moment. This is not so with Bitcoin. It is non-sovereign, so it's decentralized, and it has a hard capped supply. So there's no way that there isn't a controlling or central entity that can increase supply and inflate away its value. And in fact, the properties that make gold a strong financial asset, things like durability, inflation resistance, and limited supply, are all exhibited by Bitcoin, but to a greater degree. Some added advantages over gold, one there being scarcity. So it's actually got a finite supply, and its issuance rate on Bitcoin at the moment is 0.8 annually. That will continue to decline over time. In contrast, when we look at gold, it has an issuance rate currently of 2.3%, and the supply is reflexive. So as gold prices increase, so does the amount of gold being mined. Conversely, Bitcoin's supply rate is absolutely fixed and cannot be changed regardless of price. We can look at scalability also. Transacting in gold can be slow and expensive. Bitcoin can be sent over the internet almost instantaneously and is considered a hard store of value internet money for the digital age. And also verifiability. So Bitcoin transactions are verified by the network via a proof of work consensus mechanism, which we'll touch on in a moment. They finality within an hour. Gold verification can be costly and time consuming. There's been many large gold counterfeiting scandals over the years. Most recently, in around 2020, there was a $2.8 billion gold counterfeiting scandal by King Gold, based in Hong Kong, which some of you may remember. So many advantages of Bitcoin in comparison to gold as a financial asset. In terms of adoption, we'll just return to the millennials for a moment because they're really an important piece of the picture in considering investment preferences going forward. So millennials we consider to be, some may not, or probably most of you won't realise that they are very comfortable holding value digitally. In fact, a study out of Charles Schwab in 2019, and I expect this has probably gone up, but at that point, Bitcoin was the 5th largest holding in millennial portfolios. So a preference for digital assets to some extent. And they are not only, the millennials have not only as of 2020 become the highest income generating demographic, but they are also set to inherit $68 trillion from their boomer parents over the next 6 or so years. So really relevant to demand for this asset class and investment preferences and products going forward. We are also seeing, in terms of adoption, institutional and sovereign participation. Obviously, we've seen these regulated products launched by some of the world's largest asset managers, BlackRock, Fidelity, and others. We've seen Bitcoin become legal tender in places like Brazil and a reserve asset in other parts of the world like El Salvador. Many are not aware that the US and China actually have the largest government holdings of any countries around the world in Bitcoin. And there has been talk in the United States, many political aspirants or candidates have been talking about the potential for Bitcoin to be held as a reserve asset. So we've really seen this progression of maturation or evolution, if you like, of Bitcoin from, in the early days, it was really that kind of deep tech kind of basement geek, for want of a better term, that was investing or holding digital assets or Bitcoin. Then we saw the arrival of, early stage retail investors, then, high net worth corporates, institutions. Now we're starting to see sovereign participation and the world's largest asset managers playing in this space as well. So if you could have written a script as a Bitcoin investor in the early days for how you would want to see things play out, it's absolutely following that script to the T. We often see when the market's running very hot, investors are kicking themselves for not seeing the writing on the wall over the past 15 years. But then every time we get a fairly significant pullback of 25, 30%, we see people congratulating themselves for not being silly enough to invest in Bitcoin. It's a frustrating, challenging part of my job as a salesperson to help people kind of zoom out and see the bigger picture. All is going as it should be and has been for the last 15 years. And of course, the other point of adoption, there's investors looking for kind of a release point or removing themselves from this global hyperinflation. Things like QE Unlimited or Infinity, as I believe it was called at one point, the ECB PEP program. Simply put, the erosion of value in traditional currencies by oversupply, which is actually starting again. We're seeing an uptick in M2 money supply, global liquidity at the moment as well, which is broadly supportive for risk assets. And a cool little fact here that many are not aware of, Bitcoin adoption is actually happening at a more rapid pace than both the adoption of the internet and mobile phones. So really impressive from any angle that you look at it. The thing that keeps people out of the market really is the volatility, but that is just endemic when you have a new technology that is hype cycling, which is what we're seeing with Bitcoin. Just a bit of a cute slide here, just illustrating a really compelling point, and that is that fiat or traditional currencies are being inflated away by oversupply in recent years, I believe. So this chart finishes around 220. We're at 3.85 cents in relative purchasing power compared to a year ago on the US dollar. I think we're down around 2.2 cents as of current date. And we expect that to continue. We're seeing the US national debt growing at $1 trillion every 100 days. That can't be paid off, though. They will need to inflate that away by printing more dollars. And we are, as I said, currently seeing a re-expansion in global liquidity kind of silently bubbling away in the background. And that has been very supportive of risk assets in the past, and also very supportive of hard-capped deflationary type assets like Bitcoin. So everything going quite well. In terms of the current size of Bitcoin and the broader crypto markets, relative to other asset classes, so Bitcoin's currently making up around 55% of total crypto cap, at 1.3 trillion versus something like gold at 16 trillion. If the properties that we believe make it a superior store of value asset do indeed see it replace gold as the preferred store of value asset, then there's potentially a lot of growth ahead of Bitcoin. Even if it cannibalizes a significant portion of gold's market share, which we believe it does at a worst case, we're still seeing multiples in terms of growth. The broader crypto market's sitting currently around 2.3 trillion. So if you compare that to something like global equities, as an example, where there's efficiencies in crypto, you've got a 24/7 market, you've got global liquidity, instant settlement. These things alone should see the crypto market eat away a significantly larger share of global equities, and certainly gold, in our opinion. So we see significant potential for significant growth ahead. But having said that, we're also looking at these, these periods of kind of triple-digit annual growth on Bitcoin itself and Ethereum becoming rarer and rarer over time. So we're really placing an importance on that kind of next tier one, and also emerging category leaders, which early stage pre-token deals, which Apollo has a terrific track record of getting right. Okay, so in terms of halvings and the mining process, this is where a lot of people come unstuck. There's a couple of key concepts that you need to get your head around, and hence the reason why this is content heavy, so you can refer back to it. I think everyone by now is fairly familiar with the term blockchain technology. So Bitcoin runs on blockchain technology, and it is issued and secured by the mining process. So in terms of blockchain technology, if you think of a traditional database that's stored in a central location, has a single point of failure for nefarious actors hacking into that. Simplistically, if not entirely accurately, we can think of a blockchain-based database as having individual copies of the database stored in all of the computers that make up the network. So in order for a nefarious actor to hack into that database or change anything on the database, effectively they would need to be hacking into all of those member computers simultaneously. So as the network grows, it becomes more and more secure. So it's virtually impossible to do. That's what makes blockchain technology really secure. The mining is a process of verifying transactions on the blockchain by solving mathematical equations via the use of computational power. So effectively, All of the miners around the world use computers to crunch numbers, to compete, to solve a mathematical equation. The successful solver of that mathematical equation gets awarded Bitcoin. So successfully solving the mathematical equation results in the placement of another in the Bitcoin blockchain. That's happening every 10 minutes approximately, and the issuance of new Bitcoin to the successful solver. So that's the revenue model for miners. They crunch numbers using computer power. They compete to solve the problem. If they get the problem right, they get given Bitcoin, they sell it into the market. So there's this steady supply into the market from the miners, which drops over time, which I'll come back to. So everyone running the Bitcoin software can verify that those transactions are valid before that Bitcoin is issued. So that's where 51% of the entire network needs to reach a consensus or an agreement that the solve is legitimate before those Bitcoin will be issued. So that's the proof of work consensus model that you may have heard of. It makes the process highly, highly secure. And as I say, as the network grows, it becomes more secure over time. Now, this is a really important point. The rate at which new Bitcoin is mined or issued into the market is predetermined. It is hardwired into code, and it undergoes a halving every 4 years. So what that means, and that happens at a point in time, or actually a block, but it basically happens on the spot. The supply of Bitcoin to the miners or into the market is cut in half. So we had one in April of this year that cut the amount of Bitcoin issued, new Bitcoin issued into the market from 6.25 Bitcoin every 10 minutes down to 3.125 Bitcoin every 10 minutes. So those halvings, the previous halvings, there's been 4 in total, have created supply shocks that have precipitated major price appreciation in the 18 months subsequent to those dates. I'll show you that graphically in a moment, but basically we see the market trade sideways because we often see a bit of a run up into those halvings, and then the market cools off post halving, and then within sort of 12 months of the end of that period, we see the market kind of topping out. It's very, very cyclical, or it has been quite cyclical in the past. So that would put us around this period for the next move higher in terms of Bitcoin price over the next couple of months, and potentially a cyclical high right at the back end of 2025. Said we believe the cycle is the cyclical nature of Bitcoin, given now that the halvings on a notional value, they are, it's a diminishing amount that the halvings are reducing supply by every 4 years. And now we also have this daily passive flow of demand underpinning the market, potentially seeing the end of the 4-year cycle, but still a lot of growth ahead in coming years. So here's your halving cycle in action. So if you look here, the yellow lines on the chart there, they're the 4 halvings that we've had since the Genesis block. So we had one in 2012. We see the market for a couple of months go sideways, and then we take off a 10,000% increase in price. Bitcoin price again in 2016. We see the market trade down and sideways for a few months and take off for a big run to the top side. Again, 220. Market traded with a bit of a firmer tone this time, 700% increase in price over the subsequent 12 to 18 months. And again, we have just seen a halving. Sorry, just stop that call. We've just seen a halving in April of this year. We've seen the market has actually this time around traded with a firmer tone. In fact, we've gone to a new all-time high already, which is quite unusual. It hasn't happened previously with halvings. So we're expecting pretty big things, especially with this new source of insane level of demand for the ETFs, spot ETFs. So this is kind of where Ethereum, so Ethereum is the second largest digital asset by market cap. It went 2015. It changed the crypto landscape forever because it introduced for the first time programmable money. So smart contracts, which you've probably heard of, that could allow individuals to transact directly with each other without the need for any middlemen at all. So dramatically lowering cost and increasing efficiency. So developers can code and deploy smart contracts directly onto the Ethereum network in order to build decentralized applications that are governed by code. So again, no need for middlemen, all baked into the code. We've seen an explosion in applications. So the biggest use case so far for Ethereum and smart contracts has been in DeFi, or decentralized finance. So things like decentralized lending, borrowing, and interest earning on protocols like Aave. We've seen decentralized exchanges, so wallet-to-wallet infrastructure, things like Uniswap, which has been a very successful decentralized exchange, and more recently Jupiter, which is built on the Solana blockchain. And we've seen the arrival or the advent of peer-to-peer derivatives. So projects like Synthetics, which is a local Australian project, allows users to deal financial derivatives directly with each other without banks or brokers taking ridiculous margins. Where if anyone has worked in banking and priced up option products, you know how much fat is in those. So removal of all of that kind of predatory, if you like, margin accrual to centralized institutions. So very much like Bitcoin's mainstream moment in having a spot Bitcoin. The late July this year, we also saw the SEC approve Ethereum ETFs. They went live and started trading in the United States. So really kind of a significant moment and marking Ethereum's status as a commodity and thereby suitable for institutional allocation. Ethereum's a little bit different, as I've said. Bitcoin's appeal really is in its scarcity, transferability, and security. Ethereum's appeal really is in its utility. So Ethereum really exists as the global infrastructure platform that gives exposure to and derives value from the decentralized applications that build on top of that network. So it's a bet, an investment in Ethereum really is a bet on the future growth of decentralized commerce. I won't go through those use cases again, but I will mention NFTs. So we're really excited about NFTs. They're for the first time solved for secure, verifiable, and almost instantly transferable online ownership. They've got a lot of application beyond just your JPEGs of penguins, which I think people kind of started to believe that that's what an NFT was. It's not. It's the technology that allowed those JPEGs to be traded and held. But it's very applicable to real-world assets, fractional ownership, and created content ownership. Also not to mention their utility in standardizing ownership across the gaming space, transferable ownership across the gaming space. So there are other segments of the crypto markets beyond Ethereum and Bitcoin that we believe will provide amazing growth opportunities in future. But really, for the purposes of this introduction to digital assets, we're only covering the two largest cap assets. We're here day in, day out, living in as well for the more technical amongst you. So in terms of why you would invest in crypto, just to recap, we're seeing that as of 2020, millennials became the highest income generating demographic. They have lost trust in financial institutions, but they trust technology. As I say, that gross mismanagement of financial resources. Millennials are really considered digital natives, as I say, trusting technology implicitly, comfortable holding value digitally. They are set to inherit close to $70 trillion over the next decade. So really, really relevant. I think the importance of that point should not be understated. They will control the purse strings, they will control the wealth, and they will be what's the word? They will be potent in directing future investment preferences and products, very much changing or having their impression or imprint upon the investment landscape. Maybe getting a little tied up in my words there, but I think I'm getting the sentiment across. Seeing increasing digitisation, both economically and societally. This increasingly digital world requires a digital economy with secure money, identity, and ownership. The crypto asset class has provided those things for the first time in history. We're seeing this kind of escape hatch to digital money because investors, citizens are seeing financial mismanagement and the oversupply of traditional currencies. We're seeing increased uncertainty in the Middle East, inflation. Bitcoin solves for all of this. And as Larry Fink, the CEO of BlackRock, recently said, he believes Bitcoin is a flight to quality, so a safe haven in the midst of all of this uncertainty. We're seeing the increased attractiveness of borderless, online, open peer-to-peer economies that users themselves can economically benefit from as they become more technology literate. And of course, this move not beyond, even beyond digitization, to actual decentralization. So innovation, decentralized, inefficient business and societal constructs. We're seeing the adoption of Web3 concepts growing exponentially. There's institutional acceptance of the growth in digitalization and this real flood of disintermediation that they're being involved with. And I think user awareness of the value they create in their online lives is really growing. And we now have the ability to capture that value rather than signing it over to large centralized corporations. And just going back to that stat there, the adoption of digital assets happening faster than both the internet and mobile phones. So we saw the kind of first iteration of the digital evolution with the creation of the internet. So read-only internet. The second wave was in those kind of traditional centralized online services where you could both read and write, so online businesses, social media and the like. And the third wave, or Web3, enables ownership over the content or assets that you use on the internet through efficient peer-to-peer value transfer for allowing for more inclusive economies. I think there's been a lot of, you've probably a lot of this type of research done, but we believe that every modern investment portfolio should include a modest allocation to crypto assets. We're not talking about cattle stations here, we're talking about 1 to 5%. A lot of research shown that small allocations to crypto and traditional sort of 60-40 portfolios, stocks and bonds can not only dramatically increase returns, but dramatically improve risk-adjusted returns. So you can see the impact on returns that between a 0 and 5% allocation to crypto can have on those global 60-40 portfolios with higher Sharpe ratios as well. So institutional players are now starting to see the value of crypto in client portfolios. Firms like BlackRock, Fidelity, Morgan Stanley, all stating that's in the near term. It takes time to amend approved product lists and investment mandates. Certainly what we've been hearing is that that is absolutely happening. And we really see this kind of shifting sands of risk from, we don't advise on crypto, we don't touch crypto, to now, after sort of 15 years of it being the best performing asset class on the planet, institutional acceptance and adoption, regulated products, regulation moving forward, and potentially getting these assets into as reserve assets for sovereign wealth funds. I think really the risk now is moving to, why did I actually have zero exposure to this asset class for the past 15 years? I think that's a question that every advisor may have to answer at some point. Still a lot of challenges. As I say, we believe that future growth will be vastly captured by those future category leaders outside of Bitcoin and Ethereum, but there are really still significant challenges. There's a lot of noise when you're investing alone as an individual. There's a lot of scams. There's a lot of hidden risk. I would say that 90% of the tokens in the space are worthless. So you really need to be working with an investment manager that understands the space and can sift through the noise and assess the actual levels of risk. There are unknown or opaque risks in relation to exchanges, OTC providers, custody. It has been said that it's not a matter of if, but when. If you're leaving assets on exchange, they will be subject to nefarious actors or hackers. There's safe management and storage requires technical expertise that not every investor has. Succession can be an absolute nightmare with direct holdings. It's cumbersome. There's no perfect solution. Assets can be easily lost or mishandled. Even if they're not, you can lose access to them by the mishandling or incorrectly recording of passwords and seed phrases. So storage of seed phrases, hardware devices can be onerous and risky. So going with a professional manager, you've got the benefit of titled and audited ownership of those crypto assets. You're holding fund units. You have simplified taxation and, as I mentioned before, succession. In doing it that way, we have access to economies of scale in relation to custody, technical and administrative services. All movement of crypto assets is handled by experienced professionals that have been in the space for a long time. And of course, successful manager, this is what Apollo's done very well, can sort through the noise and access those early stage opportunities, pre-token deals in future category leaders. So our solutions, just quickly, the Apollo Crypto Fund, that's our flagship fund. It's an Australian unit trust, early 2018. That vehicle was actually the best performing hedge fund on the Morningstar database in 2021, measured against over 9,000 other hedge funds on that database. It's an award-winning multi-strategy fund, providing long exposure to an actively managed portfolio of crypto assets. It includes Bitcoin and Ethereum. It also includes positions in some tier one alt assets, as well as positions in our Frontier Fund and our Market Neutral Fund. So the two other funds we have are the Apollo Crypto Frontier Fund, based in the Caymans, inception March 22. So this actively seeks investments in layer one blockchains, interoperability networks, DeFi assets, NFTs. And we have a keen focus on that vehicle on pre-token, seed and early round investing in promising new projects in those categories. So really an altcoin basket with a real focus on accessing early stage investment, which we have some very exciting ones in there at the moment. The Apollo Crypto Market Neutral Fund, based in the BVIs, as of 2020, market neutral strategies, so yield farming and providing US dollar stable coins to liquidity pools. I think the yield on that vehicle is around 25%. Much lower risk vehicle, not exposed to directional price movement. Fund has, I believe, maybe 5 or 6% in the market neutral, and about 30% in the Frontier Fund. at the moment. So in terms of Apollo's Edge, so I've actually run family and friends money in the space back in late 2017, early 18. I did that for 3.5 years, and I've headed up a funds management division, digital asset funds management division at an ASX listed company, and also worked with a few families setting up vehicles. I can absolutely tell you that Apollo's Edge has very much been, and speaking as a competitor, external to Apollo, which obviously I no longer am. It was a really difficult thing to compete with the way Apollo was assessing and accessing early stage opportunities in the space. That's where Apollo really has been exceptional. We've been early investors in things like Polkadot and Avalanche, which both went on top 30 crypto assets. We've got some incredible opportunities in the portfolios at the moment that'll all be vesting over the next 12, 18 months, some rolling off as early as this month. Really, really solid projects that have either been revalued higher by subsequent funding rounds or pre-trading in the tokens at many multiples currently. So we're really excited about what can happen in these portfolios over the next 12 months, given this exposure to these early stage. Some of these projects we wrote the first check, and we've operated as advisors to the projects as well. So really, really early, and as we know in crypto, that can be a great thing. So that's really been Apollo's Edge. It's been very difficult to compete with as an outsider, and I'm really happy to be in the camp with the best guys in the game currently. So in terms of where we see the space from the end of this year and beyond, those ETF inflows we expect will continue to grow throughout the rest of 24 and into 25. I think Henrik is expecting around $200 billion to flow into those vehicles by 2025. Based on some research that we've done, that should put the Bitcoin price somewhere around the $200,000 per Bitcoin mark, and we expect the top tier alts to outperform that level of growth. So we're expecting a lot from this space in the next 18 months. As I say, a lot of the large players are still adjusting risk mandates for inclusion of digital assets, so potentially additional demand coming through there. Access to regulated products. We're expecting increased allocation from registered investment advisors. We're seeing growth in social metrics and virality amongst the retail investor cohort, who are slowly returning. And in fact, some of you may be aware that one of the largest exchanges in the space, FTX, went broke a couple of years ago. They are about to, in more than likely either late this year or Q1 of 2025, they are set to pay back $16 billion to their users, many of whom were altcoin investors. So we expect that injection of $16 billion back to those investors will flow mostly back into the space. So that could also have a very material impact, particularly on altcoin pricing. And of course, millennials continue inheriting wealth, largest income generating demographic. They will continue to have demand for this asset class into the future. We're seeing some regulatory relief over time. In fact, we've seen American presidential candidates across different parties strongly voicing their pro-crypto stance. Several have verbally committed to clear regulation and advancement in the space, with some talk of potential for Bitcoin to be a reserve asset in major economies, the US being one of them. Potential for a supportive macro environment. We've got an interest rate announcement coming up next week from the Fed. There's 100% markets are pricing in 100% probability of a rate cut. I think it's about 70% probability of 0.25% and a 30% for a 50-point cut. We expect the increased liquidity injection into markets, so we're seeing increasing global liquidity, M2 expansion will be supportive for risk-on assets, sorry. And given all of the above, we expect that Bitcoin and Ethereum are kind of undergoing their mainstream moment currently. So significant growth for both of those in the near term, but we expect beyond that it will be the second tier assets in the space and future category leaders that will lead the next period or leg of growth higher. So we spend a lot of time in that space trying to work out which they will be and invest in them very early. I will open up the floor to questions. Happy to take any questions that you have. Equally as happy to discuss those with you each individually. I will place a follow-up call to you all over the next week or two. If you'd like to learn more, feel free to reach out to myself. My mobile and email address are there. You can speak to Henrik if you already know him, or I can put you in contact with him if you have something that's beyond my pay grade. We're more than happy to both answer questions. So I'll just give you an opportunity to ask any questions that you have, and then we might finish up. The innovative startup investments, are these captured in the main fund? And if so, what percentage allocation over time? Okay, so the kind of early stage pre-token deals are mostly captured in the Frontier Fund. A couple of those deals we do hold. We also have around 30% of the flagship fund is allocated to that Frontier Fund. So all of those early stage investments are captured through that allocation to the Frontier Fund. Of course, there's no double dipping on fees, but we have small investments in the flagship, and the flagship invests into the Frontier Fund, if that makes sense. Do we have anyone else? Hopefully that answers your question, Victoria. Feel free to give me a call if you need a little bit more colour on that. Okay, well, thank you everybody for turning up this morning. I've enjoyed presenting, and I will enjoy following up with each of you separately. Hopefully that was valuable to you all, and we'll speak soon. Thanks again. Bye for now.